Shares of Chinese tech giants trading in the United States struggled to pare losses Friday amid intensifying concerns over China's efforts to impose sweeping new regulations on its publicly traded companies over the next several years, yielding market value losses of more than $150 billion for the 10 largest US-listed Chinese stocks this week alone. In a matter of weeks, China has introduced harsh regulations targeting wide swaths of its economy and showing investors how risky investing in its market can be, Tom Essaye, author of the Sevens report, wrote in a recent note. Yes, there's a huge market and lots of growth potential, but obviously there are regulatory risks that seem to be growing larger with every passing month, said Essaye. Last week, officials released a sweeping 5-year blueprint for the crackdown, covering virtually every sector in its market. Then on Wednesday, China's market regulators published a long list of draft rules targeting tech companies, barring them from using data to influence consumer choices and traffic hijacking activities, among other things. This is all a stark reminder that the current regulatory crackdown from Beijing is not going to let up, Wedbush analyst Dan Ives said in a Thursday note, forecasting US tech stocks, which are outperforming the broader market Friday, should benefit from the tech-focused crackdown in China over the next year. The fear with more regulation in China around the corner is a major worry that is hard for investors to digest, and it will ultimately cause more of a rotation from the China tech sector to US tech. The Nasdaq Golden Dragon China index, which tracks Chinese businesses trading in the United States, is down 9% this week and has crashed 51% from a February all-time high. European investment banks may have lost some $12 billion as Chinese education firms crashed. Forbes, China's Internet Tycoons Suffer $13.6 billion wealth drop as regulatory crackdown triggers market sell-off. Forbes.